Good afternoon, everyone. Thank you for you all joining for today's session. And as others are still joining, so it's still okay. I think we have good numbers to start with. So mm, just to introduce about me and my other colleague, I'm Manish Saraf, chartered accountant. Been into this field of audit and tax advisory for last 21 years, and been working previously with PwC, Deloitte, the Big Four Consulting, and in UAE for last 8 years. And S&B Consulting, we provide into corporate tax transfer pricing, international taxation services, and other advisory services. And with me is Prakati Dangis. He is also a chartered accountant, good experience on the international taxation and transfer pricing. Been working with PwC earlier and been helping on different clients for last over 1.5 years in the UAE jurisdiction. So today we are going to talk about on the tax return perspective. With respect to specific aspect of it, is that how do we elect for different options which are there when we are filing the tax return, and there are certain transition rules which are need to be followed when we are going to file the return. So before we file the return, we need to do initial assessment based on the respective financials each of the businesses been following. So they need to understand what are those requirements which goes in the tax return, and what inputs they need to consider while they're assessing themselves. And also some aspects we were going to talk about is on the on the transfer pricing aspect with the related parties, their disclosure requirement, and what are those transactions which are applicable to the businesses. So, and we'll briefly cover about the tax return, how it looks like, what information goes through it, what are the different schedules. But detailed focus would be on the elections, on the return, and the transition rules, and some aspect of the small business relief, because there is specific return guidance on the small business relief. So, what details would go on that? That is also we are going to cover in this. So if you look at, the overall, this slide primarily talk about, when you are preparing your corporate tax liability computation, which starts with your accounting profit as per the IFRS standard. And then you have your adjustments or exemptions reduced from that, and then finally deriving your tax liability. So there's all a guidance to each of those adjustments which we are carrying out, and there are different schedules when we are preparing the financials. So I mean, for the returns, there are different schedules which need to be filled up. So it starts with accounting profit, then we reduce the exemption income like dividend, that would be reduced. Then certain expenditures allowed, disallowed as per the corporate tax requirement, we make those adjustments in this. Then certain adjustments with respect to the elections or the transition rules which we have opted for, those adjustments need to be carried out. Then you derive at the taxable income, and then the tax payable liability. And then if you have a presence outside UAE or business in Singapore, any other entity, any other country, then the tax credit which you would receive from those will be adjusted. And if any losses which are, so the loss is only applicable from the financial period on which the tax is applicable. So as the companies mostly would have 2024 as the first tax period, so the losses of 2024 can be carried forward to the next year, and those losses can be taken as a relief claim back. And the most important thing is that this has to be prepared in AED. Currency of filing the tax return is AED. And in case you have a presence outside UAE in Singapore or Saudi or the other currency might be there being followed for your financials outside UAE. So that need to be converted to include those income in UAE and Dirham. So, and the guidance which has been provided by the FTA with respect to that is that they need to take it the average central bank rate. I mean, it could be the spot rate of that particular transaction, or it could be a monthly rate or even annual rate. So, I mean, most feasible is taking an annual average rate of the as per the central bank of UAE, the currency. So, if it is Singapore dollar, the conversion rate of that to UAE will be taken as an average annual rate to convert those balance sheet items and the P&L items. So as we are going through this, the slides, you can make your just in the chat box, you can drop your questions, and we will discuss about the queries in the, once the session is completed, we will have a 15 minutes for question and answer session. So you can drop your questions, whatever comes up in your mind. So as we would have seen, most of you would have started working upon tax return. So these are the sections which are there in a tax return. The first is primarily the taxable person information, which flows from the tax registration details, which you would have when you applied for corporate tax registration. The details are flowing from there for your taxable person information. That the elections which comes in, those elections are the options which you have, you want to choose, and that is what primarily we are going to talk about. What are those elections are? Primarily, these are temporary relief, like it could be realized or unrealized basis, elections you opt for, or a business restructuring relief, or a qualifying group transactions which are there, or if you have a foreign income, a branch which is in Singapore, those incomes, whether you want to tax in UAE or not, like those elections options you need to click, and then further detailed schedules opens up. And those accounting schedules are where you your P&L and balance sheet details, you will fill it up in this, and then those accounting adjustments are done based on the elections which you have opted in part B, and then certain reliefs which are there you carry out. And then you finally derive the tax liability on the tax credit of foreign country, you take it up. And so here the schedules will open up as and when you are filling the details, and then the information will, the details based on the schedules you open up, like if you are taking a small business relief, once you opt out yes, then the detailed schedule will open up for that, and you fill up the details on that. Mr. Jojo, I think you are scribbling on this. So can you please stop scribbling on the slides? So here is basically, with respect to the, as when we open up the tax return form, this is how it looks like. As I mentioned, there are different 8 sections which are there. So the first is about the taxpayer details. So you fill up this detail. This will automatically pre-populate from the tax registration details. So, but at the bottom of it, if you see, you need to confirm whether the details which are filled up, is it correct, or you need to make those amendment to any of the details. So if you're saying yes, then this is okay, no changes have to be done. But if you say that any information in terms of your contact number or email ID or anything needs to be updated, then you say no, and then you go back and log in again to Imartax, and then you update your profile details and certain informations with respect to maybe your TRN number is not updated, your TRN is expired, the tax registration, the trade license expired. So you go and update, update your renewed trade license copy. Then the FTA will approve that. Thereafter only you can fill up. So now in the VAT it was not such an issue, but now in the corporate tax return filing, your trade license need to be updated to make sure that your trade license, renewed trade license, is updated in the portal. So if you see in the tax return, this is overview perspective that we know that the return has to be filed 9 months from the end of the tax year. So the first tax period is Jan to December, and the first tax, most of the companies would be filing before the September 2025. But the financial period can change. Someone can have April to March, then the 9 months thereafter would be the first tax period, and it is done in the IMRA tax portal, and then the details are filled, pre-populated, and the schedules will be only, as I mentioned, is based on the specific details you fill up, like small business relief, or if you are going for transition rules, those schedules will open up once you opt yes for that. Yeah. Prakriti, can you please clean up this screen? I think there is a scribble here.
Yes, Manish, I'm looking at it. Give me a moment.
Thank you. Okay. The documents required to be submitted with the return is the financial statement, which is mandatory. Now, the financial statement can be audited or non-audited. So there is a requirement where the audit is mandatory in case the value of the revenue turnover is more than 50 million. then the financial statement need to be audited, that need to be uploaded, or if they're opting for qualifying free zone benefit, in that case the financial statement need to be audited and that need to be uploaded. But even then, if it is but it is mandatory for all, even your threshold is less than 50 million or be whatever, you need to still upload your financial statement. But the only exception which is given is in case of small business relief. So if your turnover is less than 3 million and you're opting for small business relief, then your financial statement need not be uploaded. But for all the entities, they need to upload the financial statement. And then the other document which would be required in your tax return is like when you're opting for transition rules, and the transition rule is applicable in case of companies having immovable properties or intangibles or financial asset or liabilities, and when they sell it in the during the tax period in 2024 or 25, because the market value need to be considered, and for that the 1st January 2024 market value need to be there. So for that they need to have a documentation and this supported, which need to be uploaded in the tax return. And tax residency certificate would be required, like you are a tax resident of Singapore or India or any other foreign country, then you need to submit the tax residency certificate, because the taxable income of that country, I mean the income which you derived would be taxable here in UAE, so you need to have a tax certificate. And then they look into the double taxation agreement with that country, and that benefit is given. And also like whatever tax has been paid in other country, like in Singapore or Saudi, you need to have a tax certificate, evidence of payment done in that country, and you take a credit of that tax which has been paid outside UAE in your tax return. So as per the accounting standard guidelines required in the corporate tax is, in case the revenue threshold which is claiming for small business relief or the revenue is less than 3 million, then they need to follow a cash basis accounting. But but someone who has revenue more than 3 million, but they can still apply to follow a cash basis accounting. So cash basis accounting is where you are recording your sales, collections. Sales is recorded based on the collections you made. So that is your cash, irrespective, or the payment or your liability is recorded based on actual cash payment done. But we would recommend, it's always advisable that who feels that their business revenue is going to exceed or likely to exceed, they might be having first year, second year, the revenue might be less than 3 million and they might feel that it's going to exceed. So initially from the first year itself, better to use the accrual basis, because cash basis, then you need to make a lot of adjustments later on. And then the accounting standards, which is IFRS applied, but someone who has a revenue less than 50 million turnover, then they can go for small, medium enterprise IFRS, where there are certain exceptions or not, or it is applied in the full-fledged form. So certain reliefs are given in terms of application of the accounting standard. And someone who's claiming to be forming a tax group, then their financial statement has to be consolidated. So if they have A, B, and P is a parent company. So A and B company and the parent company will prepare the standalone financials, but they will consolidate for filing the tax return. So as per the tax return, these are the taxable persons. Now you would be categorized under any of these 5 category of the taxable person. It could be juridical person, resident, non-resident, even natural person. Like if I am doing my consultancy freelancing business, which is a commercial activity, then I'm a natural person. So in that case, I would be registering as a natural person. But there are certain exceptions to the natural person. There are 3 categories, which are like if I'm earning a salary income, then that is not taxable. So you need not register for that. Or if you are having a real estate property rental income, those are also like an exemption category. And if you are investing it in the stock market, trading in the stock market, those are also an exemption category, for which you need not be registered and need not file a tax return. But other than that, if any commercial activity, they are. Now, qualifying free zone persons are, that is a category where you claim 0% taxable income. So it's a separate return to be filed for that, or a tax grouping when you are combining your multiple entities into a tax group, then a taxable, because there's going to be a single return for your group entities. So you can classify as a tax group, and then unincorporated partnership, because there is separate taxability. The partners are taxable, not the company, and the unincorporated partnership. So that is a separate category of filing the return. So this is a basic example from the tax group perspective. It could be direct or indirect. And like parent, if you see the box on the left hand side, in the bottom of it, parent company P holding B and C, Dubai and Sharjah mainland, and B holds 40% in C, and P holds 60%. So indirectly, it has 100% holding, and they can club. So the minimum threshold is 95% common holding to form a tax group. So they are eligible to do this. But on the right hand side, if you see parent T holding mainland and qualifying free zone, they cannot form a group. Even there is an indirect holding of more than 100%. Because of qualifying free zone has 0% rate and mainland has 9%. So the tax rate are different, and that's the reason they cannot form a tax group. Now, in case of unincorporated partnership, the common example is, if you have there is two partners, A and B, they form together, a company is coming together for a particular project, a highway project or any infrastructure, or mostly any building property project they're investing in together. In that case, it's an unincorporated partnership. And there are two types of unincorporated partnership: physical transparent and physically opaque. So physical transparent is where the partners, the individual company A and B, will be taxable in their own, the income what they earn from this project, from this unincorporated partnership, will be taxable in the individual hands. But they can still apply where the partnership company which is formed as an unincorporated partnership can be taxable, not the individual. So they need to specifically apply, and that becomes an opaque. And those details actually goes in the return. So when you file up the return, then you will see an option of unincorporated partnership to be filled up, because you might be earning something from your in other ventures with other companies or other businesses. Then those has to be included in your company. So you will have to fill up the details of the unincorporated partnership registration number. Now, coming to the main point, which is today's discussion, is elections. Now, these are certain options we need to be taken. Is one of them is a realization basis, which is irrevocable. That means if you have opted in the first tax period, then you cannot go and reverse. You cannot change that option in next year. So 2024 return you're going to file. If you opt for it, then in 2025 return, financial year 2025 return, you cannot go and change that. So similarly, transition rules, and another is a qualifying group, transfer within the qualifying group. So you need to be, I need to assess that whether you are getting benefit of having this option selection, so you need to assess before you filing a return. So need to assess your financials to see what is best for you. So let's understand each of these in detail. So realization basis is applicable, when you have an accrual basis of accounting. So now the realization basis, because the tax authority in UAE doesn't want to tax you on the gain which you have not realized. That means you're not encashed it. So maybe if you are having a property whose value is suppose say 1 million, and the net book value, but the market value of the property has changed to 1.2 million. So there is a 200,000, the gain which is there as per the market value, but you have not sold of that property. So that 200,000 gain is just a book gain. You have not realized it. So you are not going to go and tax for that gain. So, but that is the option you need to select whether you want to go for realization basis. That means in 2024 financials, if you have sold something, you're not sold something, it's just a book gain which is shown, then the 200,000 is only the accounting income. So you're going to reduce that gain from your tax computation. That will not be taxable. So that's an option you need to see. So here, what is the condition is that yes, you have to follow the accrual basis of accounting, and then this is only option available in the first tax return. So the first tax return for 2024, in that you have this option. And in subsequent period of return, you will not be having this option. Okay, so this is the screen which is shown will be a pop of, like, when you say, would the taxable person like to elect using the relation basis? Say yes or no. If yes, then the other detail has to be filled up, and specific for the bank or insurance provider, they can only follow this realization basis only on the capital account, asset and liabilities held on capital. So there is specific provision for them, but for all other entities, you have the option of either opting. So once you have opted for realization basis, then you on the second screen which pops up is, would the taxable person like to elect realization basis in case of all asset and liabilities which are at fair value or impairment accounting, or all asset liabilities held on capital account. So now let's look at what are those items. Now, so asset and liability subject to fair value or impairment, which are those items would be those like you have an equity investment somewhere, where you invested in some companies. So that are generally subject to the fair value. The value keeps on changing based on the market value. So if you have have invested in any private investment and you have 100,000 of investment has been done on that. So, and the value of the book value was 100,000, but now the fair value of the market has changed to 120,000 as on 31st December 2024, while the net book value was 100,000. Now, do you this 20,000, which is an unrealized gain, you are not going to tax yourself if you have opted for realization basis. So it will be only taxed in the year when you are actually selling it off. So it is a future tax will be done only when you are actually selling it off. So it is not realized. So in 2024, it will not tax. So 20,000 gain will be reversed, and the accounting income, it will be shown as a gain, but you will, and when you're filing a tax return, that adjustment will be done. Similarly, now capital asset and liabilities held on capital account. Now, what are those capital account items? Those are like, property, plant and equipment, or intangible assets, non-current asset, long-term debt. So you have financial liabilities in your books, or any receivables and payables is there. So those items which are there held on capital account, in that case, if the value has changed, so like for example, a machinery is there as on 1st January 2024, there's 100,000 value to this as a net book value. But the market value of that has changed to 65,000. So there is a loss of 35,000. In your accounting income, you would have reduced that value to 65,000. The loss of 35,000 would have been shown as a deductible item in accounting income. But when you're going to do your taxable return, that 35,000 loss which has been shown will be added back because it is not realized. The machinery is still in your books as well as physically there with you. You have not sold it off. So in 2024, the loss will be added back in your tax computation, and then you are not going to be reducing that. Now, the third point which to be noted is asset and liabilities held on revenue account. Now, what are those items? So the realized, you don't have an option for realized and unrealized basis in case of revenue account. It is a normal treatment. So you would basically account, because those are for short term, like your inventory. Maybe someone who's trading on the laptops or any electronic items, he is buying it and is selling it off, right? He is not holding for long period. So generally those are the small are for a shorter duration, and any change in the value of that will be not considered. I'll share an example. We'll go in the next slide where we talk about what are those revenue items, whether you make an adjustment. So if you have an inventory value of 100,000, but being a laptop, because of the new model coming in, then new configuration coming in, the value of existing laptop would have gone down. So total stock value was 100,000, but at the end of the year, the value has reduced to 80,000. Now you still hold that stock. Now 20,000, which was the reduction in your value, are you going to make an adjustment to it? Yes, because this is a revenue item, but only this unrealized basis is applicable in two scenarios. Either you opt for fair value or impairment accounting asset and liabilities, or on capital account, not on the revenue account. So you would treat it normally. So if book basis what has been the adjustment, that will be recorded in your taxable computation. So here are certain examples, someone who's having a financial assets, the value of those financial assets, that means they have investments in other companies whose value is 250,000 originally, but the value is reduced to 200,000. So there is a loss of 50,000, which was shown in accounting income. But when you do a tax computation, you will add back that because this is an unrealized. And similarly, in case of any land and building which is there, whose value was 10 million, whose value was 50 million, but it has been revalued to 60 million. So there is a gain of unrealized gain of 10 million. So that 10 million will be actually reduced back, because you would have shown in your accounting income, and you do a tax computation, you will reduce that, you will exclude that gain, will not be taxable. Now, the third scenario where I was talking about the laptops, it's a revenue account. I mean, being an inventory, it is a revenue account. So suppose you have, and you need to clear their stock, and you need to give a discount in the future. The price has reduced down. So the value of reduction which has happened, suppose the value has reduced by 100,000. So you will reduce, but the stock is still there. So there is a loss of 100,000, which is shown because of the reduction in the inventory value. You would reduce that, and that is allowed as per the tax computation. So you will not go add back this loss, but it will be shown as a deduction in tax computation, because it is not a capital item, it is a revenue account. Now, similar example, in case if you have a foreign currency debt, that means if you have bought a machinery from a Singapore for Singapore dollar of 100,000 as on 1st Feb, and the value of converted value was 271,000. When you actually bought that, the liability in AED was 271,000. But by the end of the year, 31st December, the value has, the AED has depreciated against the Singapore, and the liability is now changed to 280,000. So from 271,000 of AED, the value has increased to 280,000 because of the currency fluctuation. Now this 9,000 loss is there. Okay, that would be shown in an accounting income. In an accounting as per the accounting P&L. But now this 9,000 is not realized, because you have still not paid that until this year, until December 31st, 2024. So this 9,000 will be, you would have deducted in your accounting income. So you will add back this because it is not realized. So maybe in 2025, when you actually pay it off, then that amount will be adjusted in your tax computation. Similarly, the provision for doubtful debt, which we create. So this will be, this will be only when you actually realize, or there is actually, bad debt happening in that period, you will do that adjustment in the tax computation. Whereas in accounting income, you would have reduced that. So you need to add back. And similarly is the case, like, as well, I'm mentioning about the revaluation of the building. So there's one more point which you need to be careful, like, when you have done this revaluation and the value was gone up from half a million, 500,000 to 600,000 in case of any building. So there's a gain of 100,000, but there would be corresponding depreciation as well, right? The depreciation would increase. So what you're going to do is, you are not going to do the depreciation reduction until the value in the books comes to 500,000. So those will not be deductible item in your tax computation, because you are not adding that gain. So the corresponding depreciation will not be reduced in your tax computation. That adjustment need to be taken care. So another election which is there with respect to the qualifying group. Now, the qualifying group is basically where you have 75% common stakeholding. So this on the bottom side, if you see that the company A and company B having 95%, it can form a tax group, but company C is like 75% holding. So that can form a qualifying group, and any transfer which are happening between any asset and liabilities getting transferred between this qualifying group, then the gain are not taxable. And this election is irrevocable. That means in the first tax period, you will opt for it. Then in 2025 return, you cannot go and change this option. So if you have opted for having a benefit of transfer within the qualifying group, then the gain will not be taxed in the year of transfer. But there is a clawback period of 2 years. If you transfer outside the group, within next 2 years, then that the gain get taxed in that period. So it's a temporary relief. But yes, you will have to have an option in the first tax period as irrevocable. It's being irrevocable, so you cannot change in next period. So these are certain example scenarios, if you look at where you are eligible or not. So if you see a group structure, in one scenario is 100% UAE ownership between company A and company B, both are tax resident. So asset transferred is 101 million. So company is transferring to company B. In this case, it meets the condition they're holding is holding more than 75% common holding, and they both are tax resident in UAE. And there is no gain and loss being recorded. The gain, there will not be a gain in the books of A when they're transferring it to company B. Now, in second scenario, it is 65% holding common ownership between A and B. Both are subject to the corporate tax. Then office premises, some assets of the office are being transferred. But see, the holding is less than 75%. So in this scenario, they don't form a qualifying group and subject to normal tax. In scenario 3, there is a free zone entity. One of the entity like A and B. B is a free zone entity with 0% rate, and A is a mainland entity with 9%. So any asset being transferred among them will not be eligible because both has to be the same tax rate. I mean, it has to be in mainland 9% rate, because other entity is 0%. They don't form a qualifying group. So any transfer will be taxable. It will be normal tax treatment considered. Now, companies that form part of the same group, one is exempt. Now, if another entity is exempt because of their business nature, like a charitable institute. So one is charitable institute, another is a commercial entity. A is a commercial entity, B is a charitable institute. In that case, any transfer happening, then it doesn't eligible because they are not forming a qualifying group. Now the third category is C. If you see, A and B holds 100% common, and they are both resident in fifth category scenario. Um, though they made the qualifying group, but now what is happening is there's a transfer of inventory worth from company A to company B. Now this is a revenue item. Okay, this transfer within qualifying group is only applicable in case of capital item. This being a revenue item, you will not be eligible to get the relief under the qualifying group. I mean, if there is any gain, then it has to be taxable. Now there is a clawback period of 2 years. If the sixth category is that if asset has been transferred by, say, one scenario company A and B, and later on within next 2 years, this transfer is happening to third party, then in that scenario, because the transfer, it has breached the condition of qualifying group transfer, transferred within next 2 years, whatever the gain which has not been taxable in year 1 will be taxed in the year when it is transferring. So here is an example, the clawback which I'm saying. Say if company A transfers to company B on 1st July 2024, the net book value was 800,000. The market value is 10 million. So company B will record it who's getting a asset transfer 10 million, and there was a gain of, see, in this case, there's a gain of 200,000. Now the 200,000 is not taxable in 2024 when the asset is getting transferred. But in case this asset is sold off in 2025, say it is being sold off in 15th April 2025 on 12 million. So the gain of 2 million, which you there's a gain of 200,000, which was not previously taxed, will be taxed after considering the depreciation on it. So whatever depreciation is, the additional depreciation which is there because of that market value change in 2024 will be considered. The net amount will be taxable in the year when this is getting transferred. And this is a detailed schedule, which when you fill it up, this option of qualifying group, then you'll have to fill the details like taxable person make an adjustment in the current tax period for qualifying group, yes or no. So the detail amount has to be filled up in this tax. This is a screenshot from the tax return. Now, the other scenario is regarding the business restructuring relief. Now, this business restructuring relief is applicable when you are transferring the entire business or an independent part of it, or it has to be both asset and liabilities must be transferred, and then the business, when it is transferred later on continued, 75% minimum is the continuity. 70% is the stakeholding which should continue in the future year for the next 2 years. If anything is transferred within next 2 years, as we have seen in case of qualifying group, then here also in business restructuring relief, it will be taxable in the year when it is transferred. So let's look at this scenario here. Now, say a transferor at the bottom, you have made this come business X and business Y. Say it is a lease property business, business X, and business Y is a facility management. and there is 100% ownership by one person or company A owning business B and C. Now this is getting transferred. Say suppose facility management business is getting transferred to someone else, a third party. Then in that scenario, they may opt for this business restructuring relief, where the gain on account of transfer of this business facility management to third party will not be taxable. Now, similarly, here someone has a company, a parent company is having company B, like it's in the trading of the goods. That is only one business. Now that same business is completely transferred to someone else. So they can also opt for business restructuring relief, provided they meet the condition that in next 2 years, they're not disposing of anything on this. So this is a different scenarios where the transfer of entire business from subsidiary to parent, 100% owned entities both in UAE, then they are eligible for this. And it is tax neutral, so the gain or loss will not be taxable. Now there is a partial transfer of business to sister company. That means when we say that facility management or leasing company or facility management is getting transferred, then they can still benefit because even one of the business unit is getting transferred, it is 100% common owned. It can be they can take a benefit of business restructuring relief. And in case of merger of two companies also, where company A is selling off the trading business to company B, then that one single business unit is there and it's getting transferred, then any gain or loss arising in that transfer is not taxable. Any kind of restructuring where one entity is in mainland, another entity is on free zone, 0% exam, that will not be benefiting because there are different tax rate. Qualifying free zone, as we have seen in case of qualifying group transfer, if it is to the free zone entity with 0%, then they don't get a benefit of the restructuring relief. And even spin off of a seven division to a new formed company, subsidiary company, like they were having maybe a releasing and a facility management, a single business together, but they divided separate business team. That facility management is taken care by another business head, and leasing is taken by another business, and those are spinning it off. There also, when they do the spin off, then it is not it won't be taxable, and they can get a benefit of business restructuring relief. And this is a detailed schedule which need to be filled up. So example, like, there's a book in company A is transferring to company B. The book value was 2.5 million. The market value was 3 million. So 500,000 is the gain which is there in 2024 is not taxable. But yes, in next 2 years, if it's getting transferred to third party by company B, the gain which was not taxable in 2024 will be taxable in future period. This is the detailed schedule which need to be filled up in the tax return when you opt for this business restructuring relief schedule. Then another category is the foreign permanent establishment. This is applicable like, when you have a foreign branch. So a company which is based here in electronic trading company based in Dubai has a branch in Singapore. So, they have an option of having whether they want to tax that income of the foreign branch. But there is another key point to note: it should be a qualifying foreign permanent establishment, qualifying branch. So what does this qualifying mean? That branch should be paying a tax rate more than what or equivalent to what it is being paid in UAE. So 9% is the tax rate in UAE. And if in Singapore or in any other country, the branch has a tax rate at least 9% or more than that, then it becomes a qualifying because the same rate is being paid in other jurisdictions as well. And it has to apply for this election, and it can change in next year as well. I mean, in 24 it can apply, and then want to change that because of whatever condition, it can apply for change that option. But so if they opt for excluding the foreign income, then any losses or will not be reduced on expenditure pertaining to that will not be considered in UAE. So if you have opted, then those expenditures or losses will not be considered. Say for example, in a Singapore branch has a revenue of 5 million and then expenditure of 5.5 million, there is a loss in 2024, 500,000. This loss of 500,000 will not be set off with UAE because it has opted for excluding the foreign establishment, permanent establishment income or expenditure. Now, if in 2025, that same entity, Singapore entity is making 8 million, 6.5 million as an expenditure, so 1.5 million is a loss, 1.5 million is a gain. So that the loss which they had previously can be set off. So it's neither going to tax the losses, set off the losses, or nor it is going to consider the gain, the income of the Singapore entity if they have opted for foreign permanent establishment exclusion. And they need to see whether, they need to evaluate based on the DTA agreement with those country jurisdiction, whether to go for this option or not. Now, another is the transition rules. The transition rule is applicable in case of your qualifying financial asset liabilities, immovable properties, or intangible assets. Now, this is applicable only in case you are carrying those assets liabilities on historical cost basis, and you should be holding it prior to the first tax period. If the first tax period is 1st January 2024, if any assets, you need to hold that asset or liabilities prior to your first tax period. So you would have an immovable properties bought in 2020, and if you still continue to hold that, and the whole purpose of this is that the authority doesn't want to tax on the gain prior to the period when this tax is applicable. So the first tax applicability period is January 2024. So if anything gain you arise before that should not be taxable. So there is that's what the gain prior to the first tax period is excluded when you are selling in the future period, and for which you need to have the market value as on 1st January 2024 to identify what is the excluded portion of the gain you will reduce it from your total income or profit you're going to derive. So this is for the immovable property, intangible assets, and qualifying financial asset. So there are two methods for the immovable property. One is the time proportion method, another is the valuation method. And there are certain details you need to have. It is the market value as on 1st January 2024, the first tax period, and then the number of days of holding that asset you have, the immovable property you have it before the first tax period and after the first tax period. And the reason is that you will exclude the gain prior to the first tax period. So the number of days of holding prior to the first tax period should be known. And then the portion which is pertaining to this current tax period, the 2024, that portion is taxable. So here's an example in case of valuation method. On the left-hand side, I've just given the regulation steps which you need to follow. And then in the right side, I mentioned the numbers, how it looks like. So under the step 1, what you will see is that you will compare with your historical cost vis-a-vis the net book value as on 1st January 2024. So suppose this asset was purchased, the immovable property or the value was 60,000 as on 1st January 2020. Okay, and the net book value is as on 1st January 2024 in the first tax period beginning is 50,000. So you will see whichever is higher, either the historical cost or the net book value. So in this, historical cost is 60,000, which is higher, is taken, and this will be compared with the market value as on 1st January 2024. So the market value is 100,000. So the gain which has to be excluded is 100,000 minus 60,000. The 40,000 gain is the amount which will be excluded when you sell it in the future period. Now, suppose if you are going to sell it in 1st April 2024, you were selling in the last year, and the sale value was 120,000, and the net book value as on 1st April 2024 is 50,000. So the gain which you would have recorded in your accounting income is 120,000 minus 50,000, that is 70,000. Right, but you have to exclude the gain prior to the first tax period. What was the gain which you had prior to the first tax period is 40,000. So 120,000 minus 50,000 minus 40,000. So the gain which will be taxable in this year is 30,000, excluding the gain of prior to the first tax period. Now on the time proportion method, how it differs. Again, you compare in the step 1, you compare with your historical cost vis-a-vis your net book value at the beginning of the first tax period, whichever is higher, 60,000. Then what you do is in the step 2, you take the number of days of holding from your first holding period, 1st January 2020 till the 31st December 2023, immediately before the first tax period. That holding comes to suppose 1461, and you are selling it off in the 1st April 2024, and the total holding days comes to 1552. Now, so your gain will be proportionate. So the portion pertaining to the first tax period, which is 1461 out of total gain, will be excluded. and then you will tax only the remaining portion of it. So what you do is 120,000 is a value is a sale value which you are having on 1st April 2024, and you will consider either historical cost or the net book value at the beginning of the period, whichever is higher, 60,000. So 60,000 is there. So out of the 60,000, the gain, you will exclude the portion pertaining to the prior to the first tax period, which comes to 56,482, and that is the portion you're going to exclude. So 120,000 was sale value, 50,000 was the net book value as on 1st April 2024, and then the gain, which is prior to the first tax period based on time proportion, is 56,842. So that will be excluded. So the only gain taxable is 13,581 in this tax period. And this is the schedule. When you fill up the form, you will see that you opt for it, yes, and then there's a blue dark shaded here, qualifying mobile property schedule. So you will click on this thereafter, and you fill the detail about the property, the date of purchase, and all the historical cost. All those will be filled up, and system will calculate your tax bill portion of the income. Now, in case of intangible asset, qualifying intangible asset, what are those qualifying intangible asset? Like your software, patent, trademark, copyright, your licenses. So those are something which are intangibles. And again, how does they get into the qualifying criteria? Is that they need to be held prior to the first tax period. That is before the 1st January 2024. You should have been purchased that you have got acquired that intangible asset. And the method which is applicable for this taxability exclusion of that gain is the time proportion method. As we looked into for immovable property, that similar method has to be applied for qualifying intangible asset. It is only the time proportion method which is applicable to the qualifying intangible asset. Valuation method is not applicable. Now, in case of financial asset and liabilities, what are those financial assets and liabilities? Either it could be in form of receivables, loans, equity investments, or derivatives, financial instruments, or bank balances. These are the financial asset and liabilities. And then the approach or method which is applied is the market value. And similarly, you should have acquired that before the first tax period. So the portion of the gain prior to the first tax period will be excluded under this method. And this is a common example is like in the first tax period, before the first tax period, you have this value. You have it's 10,000. The company holded a share of company as 10,000, 10 per share, 100,000 units, and this was bought in 1st September 2023. And then the market value as on the beginning of the first tax period is 7,000. So the gain or loss at the beginning of the first tax period is your 7,000 market value as on 1st January 2024, and then the cost of holding that share 10,000, to net loss is 3,000, which is need to be excluded when you're computing your taxable income. Actual sale is happening on 1st April 2024 with 5,000 value, and your the cost of that asset, the cost of that investment is 10,000, so loss is 5,000. So you are not going to exclude the full loss of 5,000, but the loss which is pertaining prior to the first tax period, which is 3,000, has to be excluded from this 5,000. The only loss which is allowed is 2,000, is the loss pertaining to the tax period after the first tax period is applicable. So 2,000 is the only loss which is applicable. So this was from the perspective of transition, I mean, all the elections and the transition rules. Now we're going to talk about the small business relief and other areas, which my colleague Prakati will take it up. So Prakati, I will stop sharing and you can share your screen.
Sure, thank you, Manish. Hello, everyone. A very good afternoon. I'm Prakriti, Chartered Accountant, and having experience in working with multinationals and domestics companies around corporate tax and transfer pricing. Here we are here to discuss about the elections around small business relief, as well as the transfer pricing compliance requirement as for the UAE corporate tax return. And I hope my screen is visible.
Yes.
So now the very first thing is on the small business relief is with respect to taxable persons in the UAE who are operating as a very small businesses. And the revenue threshold that is prescribed in the law is dirhams, 3 million dirhams. So if an entity who's a taxable person operating in the UAE and earning a revenue of 3 million dirhams or lower, then it is very much eligible to claim the business relief under small business relief, which is also known as SBR. What are the eligibility criteria? That you need to be a resident natural person or a juridical person. So even if you're running a business as an individual but are registered under the corporate tax, then you are very much eligible to claim the benefit. However, there are certain types of taxpayers which are not eligible, which includes an entity which is otherwise claiming the elections under the qualifying free zone person, or any entity which is part of the multinational group. So apart from these, all the entities can claim this benefit. And the mechanism to claim is also quite simple. The person has to go to the tax return, put the revenue that they are earning in the respective year, and select the election of SBR, which we will take up in the next slide. However, there are a few important considerations while you choose to elect in or out of the SBR. First is your revenue threshold. So in the case, while the law says that SBR is applicable up to the financial year 2026, which is up to 31st December 2026, the key consideration is that you need to evaluate your turnover for the current tax period in which you are claiming the return as well as the earlier years. So in case if it exceeds in any of these criteria by the threshold, then you're not able to claim the SBR relief. The next down or the drawback of claiming this relief, although it's very simple, is that you're not able to carry forward your tax losses. So although a company having revenue of 3 million but it is incurring losses, you won't be able to carry forward these tax losses to a subsequent years, which is otherwise allowed in the law. So it's important to evaluate whether you want to go for a full-fledged return or elect for small business relief. So we have a few case studies where we will see the eligibility for small business relief so as to have our concepts very clear. In the first case, the taxpayer is a natural person who is acting as a freelance consultant. It is earning a revenue of 180,000 dirhams and it is not part of the multinational group. So the conclusion is that it will be eligible for the relief. Why? Because all the conditions of the SBR are met. In our second example, it is a juridical person. The revenue is 950,000, which is lower than the prescribed limit. And it is again not part of a multinational group. Again, the eligibility is available. It is eligible for small business relief. In our third example, if we see, it is a juridical person, which is a software development company operating in UAE, having an annual revenue of less than 3 million dirhams, which is the prescribed limit. However, it is incorporated in a free zone company. At the same time, it is qualifying free zone person and electing to be a QFZP. And that is the reason that one of the conditions of SBR is not met, and hence it's not eligible to claim a small business relief. Having said that, a QFZP company or a free zone company may year on year elect to be in and out of SBR if it decides to do so. So the law allows, it's the call that taxable person needs to make basis the various considerations. In the last example, the company is a juridical person, which is a subsidiary of a global group. And although the revenue of the company is less than the prescribed limit, since it is a part of a multinational group, it is not eligible to claim the relief under the small business relief. So while we say that it is a simplistic form, let's see how simple it is. So as I mentioned earlier, you just have to mention the taxable person's revenue in the tax return, and then you have to mention yes or no. So if you want to claim a small business relief, you need to click on the yes radio button, and then your the last part of declaration and review arrives, and that's how your return looks like. Of course, there will, before this section, there will be a detailed section on the taxpayers information, but apart from this, there are no other schedules, no transfer pricing details required to be filled in, no other elections, realization, etc. Sorry, realization is still required to be made, but detailed schedules for each of them is not required. So this is how the SBI returns are quite straightforward and simple. Now we are getting on to the transfer pricing documentation and disclosure requirement. So the transfer pricing landscape in the UAE has not been just as an effect of the corporate tax, but it has a history. So OECD, which is the Organization for Economic Cooperation and Development, in the year 2019, when it was coming up with the BEPS action plans, so there was action plan called 13, which also has the requirement for country by country reporting. So while UAE also became part of the OECD, it also adhered to the regulations and guidelines of CBCR, and that is how the CBCR regulations were introduced in the jurisdiction. Later on in the year 2022, as we all know, Federal Decree Law of number 47 of 2022 was introduced, and therefore the corporate tax was incorporated. Along with it, in 2023, there was a ministerial decision 97 of 2023, which laid the foundation on the TP documentation. It is more about the local file, the master file, and what is the requirement for each of them. A detailed corporate tax guide was also issued in the year 2023, while the corporate tax guide on the tax return was there issued in the very next year, November 2024. Now, the corporate tax guide on the transfer pricing took care of so many aspects, like and it described along with the examples that who will be the related party, who would be the connected persons, what is the definition and how to understand the concept of arm's length pricing, then what is the comparability analysis, how to determine what is the guidance on the benchmarking. But overall, it was laid on the premises of the OECD guidance, which was released by OECD in the year 2022. Now, going ahead with the corporate tax guide, which laid the foundation of the threshold limits. While we will discuss those threshold limits later on, but from there emerged what is the requirement and how the TP disclosure is required to be made in the tax return. So initially the idea or the way information was shared was that there will be a separate form. That was the assumption. But then all the transfer pricing disclosure became part of the corporate tax return itself. So now there are broadly 4 components of transfer pricing compliances. First is transfer pricing disclosure, which is all about disclosing your related party transactions and payments to the connected persons. It has a detailed long list of what else required to be made, which is part of the schedule. It also is interrelated to whether you cross the threshold which is prescribed in the guide, so on and so forth. The next is the local file and the master file. So, and it is coming from the decision 97 of 2023. So while local file is more about a taxpayer's information on the overview of the international transaction, it's how the pricing is made, how it justifies the arm's length pricing of the transactions, what is the overview of its business, and broad overview of the group of the company. Whereas the master file is more about the particulars of the overall multinational group of the company, how it is structured, how is the value chain of various products or services in which it deals, is there across the multinational group, like which entity is having the entrepreneurship capability and is performing those functions vis-a-vis which one is captive. It also depends on the factual aspects of how the multinational group is working. So all of this is required to be captured in the master file. Now there are again thresholds while for the applicability of local file and master file, which is in case the taxable person in the UAE is having a stand-alone revenue per se for its entity, which is exceeding 200 million dirhams during a tax period, or in case if it is part of a multinational group, which is defined as a company which is having existence in outside UAE as well. At the same time, its turnover at the consolidated group level exceeds 3.15 billion dirhams during a period. And if any of these two conditions are met, a taxable person in UAE is required to prepare both local file as well as master file. Of course, if you go into very factual situation, there are ambiguity on the applicability and the threshold, which we will deal later on. The third part, which is the information to support the arm's length nature of the transaction, which is preparation of a contemporaneous documentation. And by contemporaneous, we mean that it has to be prepared when the transactions were entered, or once it has to be very realistic. So it cannot happen that you entered into transaction in 2024 and you are preparing a documentation for the same in a later point in time, maybe 2 or 3 years later. So it has to be realistic and contemporaneous. Now, what does a documentation include? It's all about your comparability analysis for justifying the arm's length of a transaction with related parties. It also may include the benchmarking analysis and the transfer pricing policies that the company has adopted. It also includes the list of the related party transactions and the details of the related parties with whom the transaction was entered and how the arm's length principles is justified. So although you may see that the local file and the information to support the arm's length nature of transaction may coincide as it may look apparently, however, there are certain scenarios also because of the threshold that are mentioned in the law, because of which you may feel that there are certain transactions which may go beyond where the TP disclosure or the local file are not applicable. However, there are still related party transactions which cannot be gone without having demonstration of the documentations to say that it is at arm's length or not. And the last is the country by country reporting. So although this is not emanating from the corporate tax law, which is Federal Decree Law of 47 of 2022, however, there is a separate cabinet resolution from which it is emanating. But since it bothers the multinational groups, so that is why it can be clubbed in the transfer pricing compliance requirements. Now, while we understood on a very high level basis what all are the documentation requirement or disclosure requirement in the UAE, let's understand each of them in detail here. So if you see, the transfer pricing disclosure is required for the related party transactions with your related parties. Now, related parties are defined in Article 35 of the Federal Decree Law. And the thresholds are emanating from the corporate tax return guide. So if the aggregate related party transactions of a taxpayer with its related parties are exceeding 40 million dirhams during a taxable period, in that case, in your return, you need to mention that, yes, you have a related party transaction. All right. However, the transfer pricing schedule, which is a separate section provided in the tax return, will be applicable only when the category-wise transaction value exceeds 4 million dirhams. So this might be little complex for for a layman to understand, but the basic philosophy is the first check is that put all your related party transactions together and see what is the value. If it exceeds 40 million dirhams, then there is a second check, which is for each of the categories. And the categories have been defined as sales, purchases, assets, liabilities, interests, loans, and others. So it is quite open a few categories has been defined, but the last category, which is others, keeps the door open for all other transactions which you have entered with the related parties. And in case for each of the categories, the total transaction, irrespective of the number of related parties with whom you enter those transactions, exceed the 4 million dirhams threshold. In that case, you need to click on the related party schedule and fill all the details there. And that is a descriptive form. All right. Then there is a specific and very unique requirement in the law of UAE, which requires all the connected person payments to also form part of the TP disclosure. So in our earlier sessions, we have discussed the need for these connected persons payment is that because there is no taxation on the income of the natural persons in the UAE, and that is why that income gets non-taxed. And if that becomes part of the expenses of the juridical person, which is a taxable entity, the government wants to keep a check on the payments that is made. And in case those payments are more than 500,000 dirhams, then the disclosure is required to be made in the tax return. Again, the tax return is a self-assessment form. So all the details that a taxable person fills as is simple as your self-assessing what you think of your related party transaction, connected person payments, etc. And it's not required to be signed by any accountant. So since it is this TP disclosure is part of the corporate tax return itself, there is no separate timelines. It follows the same timeline, which is you have to file that within 9 months from the end of FY. So if you're following a FY of 2024, where the year is January to December, then the latest date to file the return will be 30th September 2025. However, that's the last date where you need to file. So anytime earlier than 30th September is also wise, and you should start preparing and assessing the related party transactions in time, before time, and you can very well file the tax return before the prescribed date as well. Now going on to the local file and master file. So these are the documentation that a taxable persons need to maintain and then keep it with itself. In case the FTA comes, knocks your door and asks for what is the local file and master file that you have prepared, you can present to them. In fact, you have to present them within the 30 days. These are also the prescribed timelines of by the Ministry of Finance. And accordingly, so again, the need for contemporaneousness of the transaction and documentation emanates from it, that although you are not required to attach these as an annexure in your tax return, you need to maintain it and keep it with you, right? Next is the arm's length support documentation. So as I mentioned, that it might happen that because of the threshold of 40 million and 4 million and 500,000 dirhams, etc., you're not required to maintain a local file or a master file. However, there would still be transactions with related parties. And hence, it's very imperative to maintain a documentation that can substantiate and justify that your transactions with related parties were entered on a basis of arm's length principles. And the most appropriate method, which are again prescribed in the law, are met. This documentation is also required to be presented and submitted to the FT within 30 days of their request. The last is a CBCR requirement, where there are two types of requirement. One is filing the full-fledged CBCR, the other is the notification. But this is applicable to multinational entities where the consolidated group revenue exceeds 3.15 billion dirhams. So the notification timeline is 6 months from the end of financial year. And in case of a full-fledged CBCR, the timeline is 12 months from the end of the financial year. Now, as we mentioned that it will be a case study based session. So we have so many cases and various permutations and combination to see that whether or not on the basis of various threshold limits of the companies and whether it is part of M&E group or not, etc., etc. What are the basic requirement in terms of the transfer pricing disclosure, the connected person disclosure, in your tax return or maintenance of local file and master file. All right. So in the very first case, if you see, the related party transaction value exceeds 40 million. So on a high level basis, you know that somewhere you have to go down and again check what is the category wise aggregation of transaction. And while we are looking at these transaction value, an important aspect here is that all the transaction value has to be dealt with on a gross basis. So if even if it is income or expenses with the same related party, you cannot net off those transactions. Income has to be looked separately on a gross basis. At the same time, expenses has to be seen on a similar periphery. So in our first example, the related party transaction category is sales and it exceeds the 4 million dirhams threshold. Now, what happens to the related party disclosure? It will be applicable. I'll put that later. At the same time, the connected person payment, since it exceeds the threshold, again, the disclosure will be required in the tax return. The revenue on a standalone basis of the company exceeds the threshold. However, it is not forming part of a multinational group. So now in this case, now the catch is that whether the local file or master file will be required to be prepared by a taxable person. So the answer will be yes. And to the answer is yes, because the law says that either the standalone revenue exceeds the threshold or it is part of the multinational group. So even if any one of those conditions are met, because it is either or, then the requirement for local file and master file will be there. But if you see, so for example, there is a taxable person. It is not a multinational group. At the same time, even in UAE, it is only one entity. And the law asks you to prepare a master file. Now, the master file is required to be prepared for your overall group's perspective. So, although the law puts a requirement for master file, it becomes redundant because you don't have those parameters to be filled in the master file. Now, in the second example, the RPT value is more than the limit. There are category of services where the transaction value is less than the prescribed limit. So overall, the RPT disclosure is not required to be. Okay, so in that case, the RPT disclosure will be required to be made. However, a detailed schedule for transfer pricing is not required. And I will also take you through in the very next slide, how does it appear in the tax return? So I've captured the screenshots and I'll tell you what is the summary of the RPT disclosure. Now, since the connected person payments, which is less than the threshold, which is less than 500,000 dirhams, in that case, connected person disclosure is not required. The standalone revenue of the company is more, and hence local file is required. In the next case, the first point to start is the overall aggregated transactions with related parties, which is below the limit. Then, whether you need to jump and see whether my category-wise transactions should be more than 4 million or not, the answer is simple no, because the first stepping stone gives you a negative answer, so you need not to do anything with that. And since the connected person payments is beyond the limit, that requirement will be there. Again, the standalone revenue is higher, so local file, master file, both needs to be complied with. In our fourth example, the aggregate RPT value is more than the limit. The category-wise limit transaction is again more than the limit. So see, loans is one of the transactions which is specified, one of the categories specified for related party disclosure for the transfer pricing schedule. So since that element is crossing the limit, the RPT disclosure is required to be met. Connected person payment exceeding compliance required. Now, the standalone revenue of the company is less than 200 million. and it is also not forming part of the multinational group. So neither of the conditions for local file master file are required, and therefore you need not maintain the local file master file. Now that's the point where I was taking you earlier, that although you need to file detailed transfer pricing schedule in your tax return, but the law says don't maintain your local file master file because you're not crossing the revenue threshold. However, you should need to have a justification or documentation to substantiate the arm's length nature of the related party transactions. And hence comes the need that even if you're not required to maintain the local file master file, that internal documentation for justifying the ALP should be there. And again, as we discussed earlier, the FTA may come and ask for that documentation that a taxable person needs to be submit within 30 days of the request of FTA. All right. In the next case, which is case number 5, the RPT value is less. So irrespective of what is the category-wise category-wise transaction value, the RPT disclosure is not required here. Connected person threshold is again less, not required. Standalone revenue of the company or a juridical person, since exceeding the 200 million requirement, although not forming part of the multinational group, LF and MF will both be required. In the next case, it is almost similar. The only check is that multinational group is again, it is part of the multinational group. So in this case, there will not be requirement of the, of filing the corporate tax. In the corporate tax return, you're not required to fill the transfer pricing schedule or even a summary of transfer pricing, whether it is applicable or not. You still are maintaining a local file and a master file. So that's again important to understand whether each of the requirement, so RPT disclosure, connected person disclosure, local file, master file, all the requirement have separate threshold limits, and each company needs to evaluate the applicability for their taxable period separately and need to be very much aware about what is applicable to them or not. And having said that, this is an annual compliance. So for the very first year, you may be filling the RPT disclosure, but it may happen that the overall transaction and aggregate level reduces in the very next year. Then you may not be required to fill the transfer pricing schedule. So every year, this is required to be evaluated in detail. All documentation needs to be prepared. What is required to be captured as part of the corporate tax return needs to be done. What is required to be kept as a contemporaneous documentation, your benchmarking and comparability and analysis needs to be done separately. In the next example, it is meeting all the conditions, and hence RPT disclosure, connected person, local file, master file, all are required. And similarly in the last case as well. All right. So this is how your transfer pricing in the return and the schedule will look like. So at the top, what we see is the preface of the corporate tax return, where the first question is whether there are any transactions with the related party in the current tax period. So once you say yes, there are related party transaction, the next question that pops up says that whether those related party transactions exceed the 40 million dirham threshold or not. And once you say yes, it exceeds, then you need to check on this blue colored icon, which is the related party transaction schedule. And there you need to fill up all the details of all the related party transactions, which is exceeding the threshold again, and put all the methods, etc., which we will take up just in a few minutes. Having said that, even if you're not crossing the threshold of 4 million dirhams, the category-wise threshold, even then, if you see this section, which requires any addition or deductions which are required as a result of adjustment with the related party transaction. So for example, you see that you have provided a loan to your sister concern, which is a related party. And in that case, you need to charge an interest on that loan. However, you have not charged. In that case, the arm's length principle say you have to, price your transaction as if it is entered into with a unrelated third party. So there will be X amount of interest rate that needs to be charged. So that will lead to, imagine if you had charged that interest, so that will add up to your taxable income, which is the addition as a result of adjustment to transactions which were not at arm's length. You need to mention that excess amount of interest which the company did not charge from its sister concern to meet the arm's length criteria. And there might be a situation where there could be a deduction as a result of adjustment. So in case it is on the other way around, where it helps you get a deduction, you can enter the same as well. However, there is a check that the FTA says that for any deduction arising as a result of adjustment to the arm's length pricing, it has to be approved by the FTA. So you cannot go and just fill in your deductions basis the arm's length adjustment, but it has to be put up as a case before the FTA, and once they approve, only in that case you can claim those deductions. And once you click on this gains or losses as a part of this related party transaction schedule, what you see is a columnar presentation which asks you about the name of related parties, what is the type of transaction that you have entered into, what is the tax residency, what is the gross income of transaction, what is the transfer pricing method. So the transfer pricing guides prescribe 5 method plus 1, which is again the OECD prescribed method. So you have to select between any of those methods. Mr. Josefa, I request you to please don't script in, on the screen. Thank you so much. So you have to select any of the methods, and the last method is the other method. So if you feel that the arm's length nature of the transaction is not justified by the first 5 principles, or maybe it is a mix of any 2 methods, in that case, you can click on the other and justify how you have substantiated the ALP of the transaction. You also have to mention the arm's length value. So if your transaction value was say 500, so you also have to mention and state that yes, my arm's length value is also 500. If not, the difference will be will be reflected as an adjustment and will go to add the taxable income of the company. Then we are also talking about the payments to the connected persons. So in case the company has an owner, shareholder, officer, or a director to whom the payment, who are providing services in the company, in that case, all the payments made to them or the benefits that they take, if that is exceeding 500,000 dirhams during a tax period, then a disclosure is required to be made. And this has to be seen per connected person and their relatives and not in aggregation. So earlier for related party, there were 2 checks. You have to see the transaction value in aggregate as well as category wise. However, for connected person, it has to be seen per connected person. And in a similar fashion, the details are required in the CP schedule, which is what is the name of connected person, whether it has a, corporate tax TRN or not, and what is the payments, as well as what are the benefits that the person is drawing, what are the description of its services, what is the value of payment, which is the market value, because the market value of the payment also needs to be justified here. And in case the actual payment exceeds the prescribed limit, in that case, there will be adjustment for the transaction, and it will again increase the taxable income of the company. Now, since we have discussed, various concepts on the transfer pricing disclosure and documentation requirement, there might still be certain misconceptions around, as we may hear from, our friends and others in fraternity or otherwise, or maybe because of the complexity of the structure which is required, which is prescribed basis various thresholds and things around the tax. So the first thing is that people may perceive that transfer pricing disclosure is only required for a multinational group. However, the TP disclosure, which we're talking about, which is, the items to be mentioned in the transfer pricing schedule in the tax return itself, it is not meant, it is not for the multinational group, but one has to see the threshold limits, which if it is exceeding, and as we discussed in the last slide, then the details need to be filled in the corporate tax return itself. The second is, if the RPTs are under, and by RPT we mean the related party transactions, if they are below 40 million dirhams, that we are talking about the aggregated transactions, in that case, no disclosure is required. However, we need to stop and assess that whether then in that case the related party disclosure might not be required. However, there is another thing called connected person payments, and that also needs to be evaluated, and if that exceeds the limit, then the disclosure is very well required in the corporate tax return. The next misconception that people may have is that only the multinational entities, which are spread across the globe, only they need the local file and master files. However, if you read the law in detail, and as we discussed in our earlier slide, that the condition is either or. So even if you are not part of the multinational group, but since your standalone revenue of the company exceeds 200 million dirhams, in that case, you need to maintain both local file and the master file. TP documentation must be filed with the tax return. So, as we have mentioned earlier, the only mandatory attachment required to be filed or submitted with the tax return is your financials, which are the signed financials. Beyond that, the local file and master file needs to be maintained by the taxpayer and need to be submitted upon request of the FTA. The SBR removes TP obligations permanently. So although a company might file its return as a small business relief and select for the election, even then, if it is having a related party transaction, the arm's length of those transactions still needs to be demonstrated and substantiated. And it might happen that the law is for up till 2026 December for the small business relief. So beyond that, the FTA may question the justifications for the arm's length of the transaction. So in that case also, those documentations need to be maintained internally. TP rules apply only to the foreign transactions or the international transactions. So there are various countries across the globe where TP disclosures or report is required only for the international transactions. However, the law in the UAE is very clear. It applies to domestic as well as cross-border related party transactions. Now, benchmarking is optional unless requested by FTA. So FTA has given its guidance. All your transactions with related party, even if it is for 1 dirham or even if it is free of cost, that needs to be benchmarked, irrespective of whether you are required to prepare a master file or a local file, irrespective of whether or not you are required to, complete your transfer pricing schedule or not. All the transactions with related parties, connected persons, needs to be determined at arm's length, and benchmarking or any other comparability mechanism could be a very wise way to substantiate the same. On a very high level basis, these are the various ministerial decisions of the FTA guides which are available and released by FTA. So a major portion is coming from the FTA guides, which is, again, as we know, is not binding in nature on the FTA, but this is where we take all the guidance from, and that has been helping to understand the thresholds and requirements and the categories and the methods and so on and so forth. So now when we say that a lot is required to be done in terms of transfer pricing, to sum up, the key areas of emphasis at this point in time will be to identify the related parties, to identify the connected persons. So in case there are any transactions with them, identify them and look that in the, from the lens of Article 35 and Article 36. The next is conducting a detailed FAR analysis. So FAR is the abbreviation for functional, risk, and the assets. So for every transaction, a FAR of both the transacting parties needs to be documented very well. And that far leads to understanding what is the characterization of the various entities, which entity becomes the tested party on whom the benchmarking needs to be done and the pricing needs to be tested. Uh, the benchmarking studies need to be kept on the basis of the FAR analysis. Monitoring disclosure thresholds. As we saw, there could be n number of possibilities where you may require to prepare a corporate tax return and give details of the transfer pricing schedule. May not be required to prepare a local file master file. It may go the other way around as well. So it's important to take a look at what the law says on the disclosure thresholds and assess your case factually from each of those perspectives. Contemporaneous documentation is the requirement of the requirement that the law has prescribed, and it's again a global requirement that if you are entering into transaction in 2024, those testing of the prices and how you're substantiating the arm's length should be done in the very year or at most before you're filing your tax return. And if you go beyond, probably you will not be able to capture the factual situation or positions correctly, and hence contemporaneous is a contemporary having the contemporaneous documentation is the key. Again, the FDA is fond of releasing so many ministerial decisions, cabinet decisions, guides, etc. It may come up with any changes in the threshold, etc. So you need to be very much aware of what the FDI is doing in terms of how it is affecting your business and the corporate tax compliances and the transfer pricing compliances. At the same time, the jurisdiction is may or may not have the if, a proper tax team within the organization. So it's important that the internal teams who are maybe learning, who may be gaining the experience and expertise over a period of time, they are trained well enough to handle these things as well. So that was all about the SPR and transfer pricing compliances. And over to you, Manish.
Yeah, thanks, Pragati, for taking us over this the connected party transfer pricing regulations. So this is basically with respect to, as we started with, the how the corporate tax return looks like. This is just a summary of, it starts with the taxable person information and then different elections which we spoke about, covering all the realization basis transition rules or small businesses, and then the accounting schedules, the income and your P&L balance sheet items which goes there, and the adjustment which takes place, and the reliefs which we have. And then next is on the next slide, so that covers your other areas of returns, uh, the adjustment which has to be done, and the tax credit in case of you have a foreign income and you want to take a credit of that, the documentation required in terms of the tax residency certificate and your foreign tax payment evidence documentation is required for that. And then finally give a review and declaration. So this is overall summary. So what you need to make sure that you use city registration, you might have applied city registration earlier. So if your trade license has expired or you have already renewed, so you need to submit it, make sure that is updated. Then you have to get your financials reviewed to align with the IFRS accounting standard requirement. And also this will help you to assess what are the elections or reliefs you want to opt for. So you can assess well in advance, and then when you file a return, you accordingly opt for it, because you need to see if you have a foreign income or you want to opt for realization basis or unrealized basis based on the business nature that need to be looked into it. And then a tax provisioning would be required as part of the closing of your financials, that need to be worked out, and the actual tax liability based once you have closed the financials, the tax liability work out, and then you finally go and return file. So you are already prepared that how much is going to be a tax liability based on different options you elect in the return filing. So yeah, I think that's basically that's what we covered, and we can take a few questions. Now I can see there are questions being there in the screen. So one of the question which is raised by Nidhin is when a company is when the Okay, let me just, yeah. When a company is choosing to opt for a realization basis, gain and losses arise, will the taxable person tax only when it is sold? Yes. So as I mentioned about, like a mole property example where the value or the book value is 100,000 and the market value is 120,000 in the 2024, but you have not sold off that asset. Only the market value has changed. So the book value has changed. So you would have booked shown as a gain of 20,000 in your accounting income, but when you do a tax computation you reduce that, so you will not be taxing on that 20,000 which is not realized because you have not sold it off. Then another question with respect to the so the UAE city law talks about IFRS. So yes, you prepare your financials as per the IFRS standards. Like for example, you might have created a provision for doubtful debts as on a estimated realization basis, estimated recovery basis for your receivables. So now, because you're creating a provision, I mean, if you're an opt for realization basis, and these are not, so this has the means you have not recovered your debt, but you created a provision. You're not sure of whether there could be a short recovery from your customers of 10% for which you created a provision. Now this is not a realized value. You would only know when you are actually collected that amount. So the bad debt which will be there will be excluded from your tax computation in the year when you actually have a bad debt. So the provision amount is will not be, so you need to add back that. So you would have created that provision in the accounting income, but when you prepare tax computation you need to add back because you have not realized that until you collect it from the customers. The another question which I see with respect to the the qualifying group. So if you mentioned that common shareholders are there, 50% holding both an entities, whether they qualify as a qualifying group. So the qualifying group criteria
No.
is it's a parent and a subsidiary relationship first. So a parent company should have minimum 75% holding in a subsidiary company, whether direct or indirect, to form that qualifying group. So it is a
No.
parent legal entity has to be there who should hold at stake of 75% in the subsidiary company to form that qualifying group. So in this scenario, it won't be able to form that. Another question which
Yeah.
Nitin has raised about the dividend being received from a foreign
From a foreign.
subsidiary.
Yeah.
So
So
in this, yeah, Pragati, you want to take it up?
So in that case, if someone is electing for a foreign permanent establishment, then the dividend get exempted, the relief is received from there. And if not, then there are provisions around the participative exemption, and if the conditions are satisfied for the preliminary, which is having at least more than minimum ownership structure of 5%. So if that be the case, then you can have relief in any of the provisions that are there.
Yeah,
Either.
and that holding has to be there for 12 months period, and you meet those criteria, then you are able to. And then also there's a 9% minimum qualifying, the other countries should be paying that tax amount. That should be the
Yeah.
minimum eligibility. Pragati, so there's another question with respect to, I mean, with respect to transfer pricing. So if I don't cross any threshold, but want to have a qualifying free zone
All right.
status, and I need to have TP documentation, and what does it mean from, uh,
So,
your master file and the local file for that purpose?
all right. So once a free zone entity is claiming a relief under qualifying free zone person eligibility, in that case, one of the prime conditions under Article 18 is to maintain a TP documentation. And by TP documentation, we means master file and a local file. So although you don't cross the threshold, but since you are claiming yourself or electing as a QFZP, then you're required to maintain TP documentation. That means a master file and a local file. The next question is again on the contemporaneous documentation, where the question is that does it have any template or any discretion of the company? So there is no defined contemporaneous documentation, but the law says that it has to be able to justify the arm's length of the transaction. So on a very high level basis, it should identify which is the related party, what is the related party transaction, what is the nature of transaction, what is the pricing around the transaction, whether this pricing is on an arm's length basis or not, whether it is leading to any adjustment of on the arm's length basis. So these are the major criteria for maintaining your contemporaneous documentation, which essentially also includes having a benchmarking study and identifying your related party transactions.
Yeah,
Yes.
Prakati, the next question you want to take it up regarding the deferred tax asset and deferred tax liability.
Sure. So when we selected for realization basis, what is the impact on the leases, whether we need to create a DTA? So DTA and DTL is where there is a timing differences, a temporary timing differences in the outflow of the taxes. So of course, in the case of leases, one has to, understand in detail whether this is a finance lease or an operating lease. And in case of there is a timing difference that the taxability is deferred to a future period. In that case, deferred tax liability needs to be created in the books of accounts. Whether offshore company required to pay 9% corporate tax for their income earned outside the UAE. So I think the law is clear that it has to be a resident juridical person for the applicability of corporate tax. And in case if it's an offshore company, probably the tax residency needs to be looked into, and accordingly, the taxability in UAE needs to be determined. Midhu is asking, managerial remuneration can be considered as a payment. Okay. Is it required to charge interest on loans from proprietor? If yes, at what rate? So see, a person can be a connected person. At the same time, it can be a related party. So the connected person payment is only with respect to the services that he's providing in the company. All right. So yes, managerial remuneration of an owner, shareholder, director, officer, which are there in Article 36, will be a connected person payment. However, if the same person is giving loans and the company is, paying interest on the same, it will again come in the related party disclosures. What rate? So it all depends on the benchmarking study. It is very, very specific to the facts of the case and of the loans, the arrangement. So what is the amount of loan? What is the duration of loan? Again, the purpose is important. Your credit rating becomes very important factor. What is the repayment schedule? So based on the factors, an arm's length rate can be arrived at, which can be taken through the benchmarking, which can be done on a maybe Refinitiv or loan connector database, etc. So now can methods of TPP change to a different RPT? Is one method for one category? Of course, of course. So see, it totally depends on the nature of arrangement. And accordingly, the method can be arrived at. And each method has its own science and logic behind it. So, only it's advisable to reach out to experts and advisors as to which should be the best or transfer pricing method, and of course it may differ from transaction to transaction. All right, I think that's the end of the
Yes.
questions that we have.
Yeah. Great, great. So thank you all for being present today. And I mean, if you have any queries or questions you want to discuss, my number is displayed in the email. My email ID is also there in the screen. You can make a note of it, and we can help you to understand or have a further clarity on whatever queries you have. I think someone has just put up a question on, about the free zone company doing a qualifying activities, but having some services as ancillary activities, and the activities goes more than 40% in case the company still exempted. I think, it has defined that if you have more than 5% outside the qualifying free zone activities, and then
The
you
de
are,
minimis criteria
yeah,
should be 5 million dirhams or 5%.
5%, yeah.
Beyond that, then the overall entity, although incorporated in a free zone, cannot take the benefit of the qualifying free zone elections.
Yeah. Yeah.
I hope that answers.
Great. Yeah. Great. Thank you once again, and we'll keep posted to you that our next session or seminar, webinar we are going to do. And we will share this link, the webinar link, what we have conducted, we have recorded this, we will share it to you. So maybe if you have not registered, I've shared the link earlier for registering yourself. And if you have not registered, you can register so that we get your email ID and we will email you this webinar link. Thank you so much.